Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. It's been a few tough years for many income investors who have seen their portfolios get pinched by higher interest rates and really left in the dust by growth stocks. Earlier this year, the Wall Street Journal even suggested that dividend investing was dead. But it's starting to feel like that could finally be changing with some of the recent turbulence we've seen in the stock market that has helped dividend stocks outperform over the last few weeks. In today's video, I'm going to talk more about this shift and why now could be an interesting time to consider dividends for income and capital preservation, especially if you've been hiding out in money market funds that face looming interest rate cuts or tech stocks that could increasingly see their rich valuations catch up with them. But to understand where we could be headed next, it helps to know where we've come from. If we turn back the clock, the landscape for income investors has changed tremendously since Fed Chairman Jerome Powell made one of his more ridiculous remarks in 2020 when he said that the Fed was not even thinking about raising rates. Of course, over the next 4 years, the price of almost everything soared at a pace that hadn't been seen since the 1970s and early 80s. We've felt that buildup of price pressure across many everyday goods, and I liked this chart from the Wall Street Journal, which showed how much certain household products changed in price from February 2020, right when the pandemic was starting, through February of 2024. My youngest kid is still in diapers, and we have another on the way, so we've certainly felt baby wipe prices going up over 50%, but you also have eggs rising from about $2 a carton to nearly $4, and even basics like potatoes and ramen have jumped by over 50%. You can point your finger at everything from federal budget deficits to money printing and even corporate greed for some of these sticky price increases, but the Fed's job is to keep annual inflation near 2% while supporting a healthy labor market. The Fed primarily tries to do this by controlling short-term interest rates, which policymakers have moved from 0% to over 5% today, hoping that higher rates will help slow demand and cool inflation since they increase borrowing costs for things like homes, cars, and business expansions. While today's interest rate above 5% isn't crazy compared to history, investors haven't seen this level since before the 2008 financial crisis, and the Fed hasn't raised rates as quickly since the 1970s. These hikes have weighed on the performance of many different dividend stocks since, compared to the tech sector, which has done really well the last couple of years, mature dividend payers are typically more closely tied to the broader economy, which has been slowing down in response to rate hikes. Dividend payers also tend to be more capital-intensive businesses and therefore bigger users of debt, which has become more expensive. And some of these higher-yielding stocks now have more competition for investor capital since investors can get a 5% yield with low risk from money market funds and CDs. To see how much these headwinds have weighed on dividend strategies, I put together a table showing the total returns of each sector in the S&P 500 along with several popular dividend funds. I measured performance from March 2022 when the Fed announced its first rate hike during this tightening cycle and ran the numbers through early July of this year, which was right before the market's turbulence over the last few weeks. The S&P 500 returned over 30% during this time, with the tech sector's 58% surge nearly doubling that gain. The communications sector was strong as well and includes a lot of tech companies like Alphabet, Meta, and Netflix. But if you weren't a large cap tech stock, you probably didn't have such a good time. Real estate investment trusts, or REITs, lost 12% during this period. Utilities squeaked out a small gain of just 4%. Dividend aristocrats didn't do much better with an 8% return, which equaled the gain of Schwab's popular dividend ETF, SCHD. Basically, most of the popular areas for dividends trailed the market by at least 20%, and the tech sector by at least 50% since the Fed's rate hikes began, which is a pretty crazy divergence. Price alone isn't a very helpful indicator though, but we can look at price to earnings ratios or P ratios to see how much the market is paying for every dollar of profits that a company generates. This chart from FactSet shows each sector's P ratio in dark blue compared to its 5-year average in light blue and 10-year average in green. The tech sector grabs your attention right away with a P ratio of nearly 30, which is well above its 10-year average near 20, as well as the S&P 500's current ratio of 20. In contrast, defensive dividend stocks like utilities trade about in line with their 10-year averages and at a historically wide discount to the broader market. In fact, utility stocks haven't lagged the market this much since 1999, which was the final innings of the dot-com bubble inflating. The next year, in 2000, utilities gained nearly 60% while the S&P 500 fell 9%. Now, I'm not saying history will repeat, but the market's volatility over the last few weeks showed how quickly things can change. From July 9th through August 5th, the S&P 500 lost 7%, with a sharp sell-off during the last 2 days of that period as investors worried that a recession could in fact be on the way, given signs of growing softness in the labor market. The biggest winners during the Fed's rate hiking cycle became the biggest losers, with the tech sector shedding 16%, while utilities, REITs, and most dividend ETFs gained at least 5%. Now, I have no idea if that'll continue or not, but if we hit a recession or artificial intelligence fails to live up to the hype that's priced in, I could see this reversal being in the early innings given how big the tech sector has become. Back when I started our website, Simply Safe Dividends, in 2015, the tech sector was around 20% of the S&P 500. It is now approximately 40% of the market if you include Amazon, Meta, and Google, which technically reside in other sectors. It's become an increasingly top-heavy market as well, with Apple, Microsoft, and Nvidia each accounting for over 5% of the S&P 500 and trading at forward P/E ratios that are near 30 or higher. While these valuations aren't as crazy as we saw during the dot-com bubble over 20 years ago, the sheer size of these companies makes their lofty multiples harder to swallow. For example, if you adjust Nvidia's current market cap for inflation, it would have still exceeded $1 trillion in the year 2000. That's nearly double the peak market cap reached by Cisco, which is often considered the poster child of the tech bubble since it briefly became the world's most valuable company and at one point had a P/E ratio of nearly 200. This environment feels a little uncomfortable if you're an index fund investor trying to find a safe withdrawal rate and dependent on the overall market. What if AI hype doesn't live up to reality? What if tech gets revalued lower for any reason? I don't know when the broader market will stop being narrowly led by high P/E ratio stocks, but as a buy and hold dividend investor, I don't have to make those tough calls to protect my income stream. To give you a quick example, I actively manage 3 model dividend portfolios on our website, Simply Safe Dividends. Our conservative retirees portfolio's goal is to generate a yield between 3.5% and 4.5% and preserve capital over time. The portfolio started in 2015, and you can see that each year it has steadily grown its dividend income stream, which is represented by the purple bars here. It's a really simple buy and hold portfolio with 29 high-quality dividend stocks that have dominant positions in mundane industries like trash collection, delivering electricity, providing insurance, selling food and beverages. While it's not the most exciting portfolio, it has a P/E ratio below 19, which represents a moderate discount to its 5-year average multiple, as well as the S&P 500's P/E ratio. The portfolio's earnings are expected to continue growing by around 5% to 6% per year as well. And while that's nowhere near as fast as the tech giants, which trade at an average P/E ratio that's nearly twice as high, I think our growth is more reliable over the long run since we own mostly stable, time-tested businesses like regulated utilities that just have a narrower range of outcomes. While our portfolio's 3.6% dividend yield is lower than the 5% rate you can get from money market funds, our yield grows at a mid-single-digit pace each year, while interest rates seem likely to be cut closer to 3% or less, assuming inflation keeps decelerating. In other words, a dividend portfolio like this should generate significantly more income over the next decade than a money market fund, since those rates aren't forever, and they don't grow. Now, dividends aren't for everyone, but I think this strategy offers an especially interesting safe harbor should tech stocks fail to deliver on their lofty expectations and if rates start coming down, especially if we hit a recession that accelerates the process and leads more investors to desire lower risk investments for really the first time in years. For now, dividend investors just need to tune out the noise and stay the course. The rest should eventually take care of itself as long as our portfolios steadily grow their earnings and dividends. I hope this video was helpful if you've been thinking about an income investment strategy that you can stick with for the long run. If you enjoyed it, it'd really help me out if you hit the like button below and even considered subscribing to our channel, which will stay focused on analyzing different dividend stocks and funds, as well as just sharing investing tips on this strategy. You might also want to check out our website, simplysafedividends.com. This website makes it really easy to generate safer income, vet ideas, keep your portfolio between the guardrails. You can research dividend stocks with a click to see their dividend safety scores and different key metrics across valuation, fundamentals, dividend growth charts. You can also track your portfolio's income, safety, and growth, get our model portfolios in our newsletter, and a lot more. It's free to try, and it only takes a minute to sign up using the link in the description below. Thanks again for watching, and I hope to catch you next time.